Okay, let's go ahead and do the work together 13-2, calculating profitability margins. And it says information is taken from financial statements for this company, KL Marketing Group, and they want us to calculate the following measures: round to 0.1% in the nearest penny, and there's our 5 profitability ratios, and then compare each of these to the target and say whether it's a favorable trend and result. And then the last thing is explain one of the ratios, operating margin, and what it tells you about this company. So here's all the data that they give us, and similar to what I did in 13.1, I'm just going to go ahead and assume you can scroll back up and pick off these numbers. These are kind of our choices of things that we would use in profitability analysis. And I have put in the actual ratio already, and I'll let you do that here for a second. So now that you have all of that data in, let's just go through this favorable trend and favorable result. So again, favorable trend is saying from previous year to this year if things are getting better or worse. So for gross margin, 64 to 61, that is worse, so I'm going to say no. My answer key says yes, so I'm hoping it's just a bad answer key in writing. And favorable results saying, does it hit our target or not? So our gross margin's at 61.6, it's outside the range, so it is not a favorable result either. The operating margin is going up, which is a good thing. Is it within our target? It sure is. 9.3 is in there. And then let's go ahead while I'm on this one, because it's 9.3% on operating margin. Let's go down and do the third part of the question. And if you recall, operating margin is income from operations divided by net sales, and a lot of investors do this to compare you to another company. So KL Marketing Group operating margin at 9.3%, which we just calculated, means that for every dollar of sales, of net sales, they're earning 9.3 cents of income from operations. And do I know if that's good or bad? I don't, without comparing it to some other company and whether or not we compete well. So let's go back up here then, since we're done with operating margin. And rate earned on average total assets. Favorable trend, it went up, which is good. And it wants you to be between 8.5 and 9.5. And 9.2 is. Last year, not so good, but this year, yes, so it's favorable. And then the rate earned on average total equity went from 12.8 to 14.5. That's a good thing. And our 14.5 is in our target range, so that's a good thing. Our free cash flows went down, so that's not good. And we'd look at more than just 2 years typically on a lot of these to really determine what the trend truly is. And then it's at 46.9, which is in there, so that is a good thing. So that takes care of kind of all the analysis you have to do, because we answered about operating margin. So let me go ahead and, similar to what I did on 13.1, here is the first couple, gross margin and operating margin, and I did what the calculation is. And notice for these two that when it's margin related, we're talking as a percentage of sales. Okay, so gross profit, income, operations, you can kind of get the numerator based on its name. And we're dividing to get gross margin and operating margin. And I've given you current year, and then the prior year total, but I'll let you go pluck off the rest of those numbers. Okay, so then we have the third ratio, which is rate earned on average total assets. So anytime you see average anything, the first thing you need to do is calculate that average. So here's the calculation for that average. And then you go back and you say, what's divided by what for the true ratio. So when I see rate earned, I think return and I think net income. And on average total, so divided by average total assets. And then the fourth one is the rate earned on average stockholders' equity. So again, as I see this, I first see average and think I need to calculate my average stockholders' equity. So I'm doing that here. And let me flip over real quick so you can get those two numbers if you need to pause it. And then I'm going to use those here in a second. So once I've calculated the average, then I know to go figure out what's in the numerator and denominator. So rate earned tells me return, tells me net income, and then I take that average stockholders' equity to get this last rate earned on average stockholders' equity. You'll hear me call that return on equity a lot and return on assets for the other one because that's what really in the industry people tend to use. And then finally we have our free cash flow, and that is especially, or what you would think it is. So as soon as I see cash flow, I think my numerator is cash flow from operating activities, and this one is not divided by, it's minus capital expenditures, what I spent on equipment and things like that. And again, I have the current year. We already talked about operating margin and explaining that for KL operations. So that wraps up Work Together 13-2.